Hello and welcome to the next of our full course lectures. This lecture begins our look at risk management. So we're going to look here at how an organisation manages the various risks within that organisation. We're going to look at it over two lectures. So this will be an introduction to risk, looking at some risk management, enterprise risk management, and the different types of risk that we can see within an organisation. In the next lecture, we'll then go on to look in detail at how an organisation can manage its risk. So let's think about what risks are and what risk management is. So first of all, we need to realise that there is a link between risk management and corporate governance. So we think about our internal controls, for example, and when we talked about internal controls, we said that internal controls should be designed so that they reduce risks to an acceptable level. So that's what we're thinking about with risk management. We can also link it directly to corporate governance and say, well, there are a few risks with the organisation when it comes to corporate governance. For example, there's the risk that the organisation doesn't fully inform shareholders. We talked in our shareholder relations lecture about how corporate governance codes require us to keep shareholders informed. Well, if we don't do that, that's a risk to the organisation, the risk of not complying with corporate governance and not informing shareholders adequately. We also have a risk of treating shareholders differently, and remember, we shouldn't do that. We should treat all shareholders the same, we should give them all the same information and ensure that they're all treated equally. Also, when it comes to corporate governance, one of the key things we have to do is provide information. Well, if we have a lack of disclosure as an organisation, that's a high risk to our corporate governance because we need to provide the information to the shareholders and to the stakeholders that our corporate governance codes require. The main issue that we have with our risks is that we could have poor controls over those risks. We're going to look at risk management, and part of risk management is to identify the risks and then to decide how we're going to deal with those risks. Now, often what we'll do is we'll put controls in place to deal with those risks. If we don't have adequate controls in place, those risks could occur, and that could enable us to actually make losses rather than profits. So one of the big problems with risk management is that if we don't get it right and we don't have adequate controls, well then that could lead in itself to losses for the business. So let's look a little bit more deeper at what risk actually is. What do we have? Well, first of all, we have downside risk. So this is what we all think of as being risk, the risk that something bad happens, i.e. the risk occurs and that risk causes a loss to the organisation. So that's defined as downside risk. But don't forget that we also have something called upside risk, and that's the risk that it occurs and it actually leads to a gain. Think of foreign currency movements, for example. Well, there's a risk that the foreign currency transaction could go down, leading to a loss. But there's also a risk that the foreign currency transaction could go up, leading to a gain. So there's both downside risk and upside risk there. Don't forget about both because both are very important. I'll introduce this concept in more detail in a second, but don't forget that an organisation must take risk to make rewards. You cannot make a profit if you don't take some element of risk. So we need that upside risk. And to deal with upside risk, we also have to take account of downside risk. So let's bring that all together and say, right, what are we going to do with our downside risk? Well, that downside risk will be required to provide a return. Okay, we need some downside risk. Less risk equals less return. If you're not taking as much risk in an organisation, you're potentially not making as much return. But we need to balance that because don't forget, if we take too much risk, that can equal a disaster. We can see that through the financial crisis that's occurred in the late 2000s, that organisations such as banks were taking far too much risk. Their risk management was inadequate, and ultimately that led to large losses, not just for them, but for the economy as a whole. So too much risk can lead to disaster. So what are we going to do with this risk? Well, what we're going to do is try and make the risk as low as practically possible. Okay, so we've got it here as low as reasonably practical. Same thing, as low as practically possible, i.e. we need to find a balance. So we need to find the point at which we're taking enough risk to provide the return that shareholders require, but we're not taking so much risk that we're risking the organization actually going into liquidation. Okay, so we need to find a balance between the upside risk that we need and the downside risk that we're trying to avoid. So in order to do that, we're going to have to manage our risk. So we need to have a risk management process. So why do we need this risk management process? Well, the first thing we'll need to do is identify the various risks that the organization faces. So by having a risk management process, part of that will be to identify all of the possible risks. Once we've identified all of the risks, it doesn't stop there. We need to also identify any changes in those risks. Risk management is often thought of as a cycle. So you keep identifying risks so that if there are any changes in those risks, you're aware of them and you can then deal with them. Once you've identified the changes, you can then take advantage of the upside risk. So take advantage of the upside risk and try and avoid the downside risk. So remember, this upside risk is something that's increasingly considered by organisation. Risk management used to be just thinking about the downside risk and how to avoid that downside risk, but upside risk is now seen as an opportunity. We can use upside risk to enhance shareholder value. We can actually go and find upside risk. We can take advantage of it and potentially increase the returns within the organisation. So the risk management cycle, which we're going to look in more detail at in the next lecture, is to first of all do that risk identification. So look at all of the risks that there are out there that face the organisation and identify them and categorise them. We then assess those risks, and we're particularly looking at the likelihood of them happening and the impact that they will have on the organisation once they do happen, or if they do happen. And we're going to look at that in great detail in the next lecture. We then have to do risk planning, and that's trying to decide what our response to the risk will be if it actually occurs. Lastly, we'll undertake risk monitoring. So this is where we're identifying the changes. Risk monitoring is an ongoing process to try and see what has changed and if there are any different risks out there. And that begins the cycle all over again with your risk identification, risk assessment, risk planning, and continual monitoring. So risk management cycles are embedded within an organisation. They're something that an organisation should be doing at all times. And there are various models for doing this. One of the key models for doing it is called ERM, and it works on a sort of a matrix structure like this. ERM is Enterprise Risk Management. Okay, Enterprise Risk Management. So this is a particular model for actually balancing the risk within an organisation. So what does enterprise risk management do? Well, really it focuses on making risk a holistic approach throughout the entity. So something that everybody within the organisation thinks about. It talks a lot about embedding risk management in the organisation, embeddedness. And what that means is that everybody in the organisation is aware of the risk management cycle. Everyone in the organisation is aware that they should be looking for risks in their particular sector of the organisation. And they can therefore make sure that all of the risks are managed appropriately. So this was a response to sort of globalization and accountability to make sure that everybody in the organisation understands what their role is when it comes to risk management. So really we can think of enterprise risk management as a framework that the entity can use to understand the risks that are facing it. So there are some main principles in enterprise risk management that you need to be able to discuss. Number one, it relates risk management to the strategy of the organisation. Remember we said that you can't make returns without taking some risk. Well, enterprise risk management recognizes that fact and says that when you're setting your strategy, you must bring risk management into that. You must make sure that you understand all of the risks to the strategy, and you must use the risks, the upside risk, to actually make sure your strategy will move forward and make returns for the organization. So you must relate the risk management in the organization to the strategy. That means that the tone for risk management must be set at the top of the organization. So remember, we talked about our control environment. It's a little bit like that. It's a bit like setting the risk management tone at the top of the organization and making sure that that feeds down throughout the organization. So once you've set the tone for risk management at the top of the entity, well, then you can make sure that everyone is responsible for their area of risk management. Remember, we said that this was going to be embedded in the organization. Well, that means that everyone will know about it. Everyone will take their responsible actions, and they will therefore know what their role is and make sure that they carry it out. We also need to consider a wide range of risks across all sectors of the organisation, not just thinking about one particular area, but thinking about risks wherever they could occur. Ultimately, enterprise risk management is embedding risk management within the culture of the organisation, making it part of the organisation and ensuring that it therefore is given prominence when it comes to trying to identify risks and manage those risks. So the components of enterprise risk management are that you'll need to consider the internal environment of the organisation and try and manage the risks that occur within that internal environment. We'll need to set objectives. We'll need to understand those objectives, the risks that could occur in those objectives, and manage those risks appropriately. We'll then go into our risk management cycle with event identification. So we'll identify what potential risks there are out there to the organisation. There'll be our risk assessment, which we'll talk about in the next lecture, about identifying the likelihood and the impact of those risks, and our risk response, which again we talk about in our next lecture. We know that we have our control activities within the organisation. We've looked at those in quite a bit of detail, so we understand that we must have those control activities in order for the organisation to reduce the risk of fraud and error and to make good shareholder returns. And there needs to be information and communication within the organisation. If we're going to embed this risk management within the culture of the organisation, everyone needs to know about it, so that's communication, and the information needs to be out there so that they can learn what it actually is. Lastly, remember monitoring. We talked about it in our risk management cycle. Monitoring is all important. We always monitor all of these different areas to make sure that there are no risks that we're missing. So the main benefits that will occur by having risk management or enterprise risk management within the organisation are that, first of all, we'll make better decisions. Now that might come about because we avoid the risks making those decisions, or it may simply come about because we get more information. By analysing the environment in more detail, by undertaking a risk assessment, we understand the environment better, and therefore we can make better decisions. We should have investor confidence. If investors know that we have enterprise risk management within the organisation, well then they're going to be more confident in the organisation itself, how it manages its risks, how it goes about its business. We'll have that risk focus. Remember, we said internal controls must have a risk focus. And everyone in the organisation is aware of the risks facing it because it's embedded in the organisation and everyone therefore knows about it. This may all ultimately lead to a reduced cost of capital because investors will be more willing to invest. They feel they're not taking as much risk, so they maybe don't need as much of a return. And that's what your cost of capital is, the amount of return required by investors. That may be reduced by the fact that we have this enterprise risk management within the organisation. Let's now look at illustration 1. So it's focusing on this embeddedness of risk culture. So let's have a look, read through the scenario to make sure you understand it, maybe have a go at the illustration and then work through the answer with me. Illustration 1, requirement 1 first asks us to define risk embeddedness and then to explain the methods by which risk awareness and management can be embedded in organisations. So first of all, we're looking at what risk embeddedness is. And remember, this refers to the way in which risk awareness and risk management are interwoven into the normality of systems and culture in an organisation, i.e., this is how we get the awareness of risk into our culture in the organisation so that everybody's aware of risk and everybody knows what their risk management procedures and requirements are. So how can we go about getting this risk embeddedness into the organisation? Well, we could align individual goals with those of the organisation. So the need for alignment is important because risk awareness needs to be part of the norms and unquestioned assumptions of the organisation. So that's part of the normality of the organisation. Training of staff at all levels is essential to ensure that risk is embedded throughout the organisation. So we need to put training measures in place to ensure that staff are aware of risk management. We could also include risk responsibilities with job descriptions. So that would mean that employees at all levels have their risk responsibilities clearly and unambiguously defined in their job descriptions, so they know exactly what they have to do. We could establish a reward system that recognises that risks have to be taken. Remember, it's not just downside risks we're looking at here, we're thinking about upside risks to attain reward. So those employees that are expected to take risks, maybe they're planning investments, for example, should have the success of these projects included in their rewards. Also, establishing performance indicators that monitor risk management will help. That will ensure that accurate information is always available to the risk committee and/or the board, and there's no incentive to hide relevant information or indeed to fail to disclose risky behaviour or poor practice. A suggestion box is one way of providing feedback to management, so we could set that up to ensure that the employees actually feed back their thoughts to management. Lastly, communicating risk management messages to staff will mean that we have internal communications, and that's important to develop the culture and also to continually remind staff of the risk message. Remember, embedded means that it's within the culture. So if we have the information out there, well then everybody will be aware of it. So that was requirement 1. The second requirement was to examine the obstacles to embedding liquidity risk management at UU Limited. So this time we're thinking we want to embed liquidity risk management at UU Limited. We'll look in detail in the next illustration at exactly what the liquidity risks are, but how are we going to embed this in the organisation? Well, there are some obstacles. The case draws attention to 3 aspects of working capital management, and that's payables, receivables and inventory. Remember, if there's a deficit in working capital, we need to fund it through our own cash. So that will be inventory plus receivables less payables. That will be the working capital requirement of the business. The individual managers of the company are all acting in isolation. They're not working together for the good of the company, and that seems to be one of the main obstacles to embedding risk management for liquidity risk here. For example, the sales managers desire to have high levels of finished goods for maximum customer choice. So it's quite reasonable for the sales manager to support high levels of finished goods, but there's an inventory holding cost associated with that, and that's going to increase the amount of money tied up in working capital. So if you have lots of finished goods just sitting there in stores, okay, customers can come and look at them and decide what they want, but it's not good for our cash position because we've invested our money into those goods and it's tied up. We have to get it back by selling them and getting the money. Also, we can see the manufacturing directors, they've got a desire to have high raw material levels, and that's throughout the manufacturing process. So clearly his effectiveness as head of manufacturing will be partly measured by the extent to which the factory fulfills orders and avoids disruptions to production that arise through inventory stockouts. So you can understand that he wants to keep high levels of raw materials because he wants to avoid a stockout. But again, that will be putting pressure on the liquidity position of the business. So he prefers to have the raw materials in stock rather than having to order them in because he's got that supplier's lead time. But again, that's going to increase liquidity risk. The ineffective credit control department is an issue here. According to the manufacturing director, the credit control department, which is responsible for the timely payment of receivables, is poor. So the vulnerability to liquidity risk is clearly influenced by the number of days receivables are outstanding. So an ineffective credit control department is a major obstacle. They've got to work hard to get the money in for the business. So if you sell goods, you've got to get the money for those goods as quickly as possible. If you've got an ineffectual credit control department, that will be an obstacle and that will increase the liquidity risk. Lastly then, the CEO's desire to pay payables early as part of the company's social responsibility efforts. That's costing the company an average of 10 days payable on most accounts. Now, that's a big issue and has been identified by the others as something that could increase the liquidity position that could benefit the company. The fact that it's the CEO himself, though, that holds this view may mean that that will be a difficult thing to change. So those are all obstacles to try and embed the liquidity risk management within this company. Now that we understand how important risk management is in the organisation, and we've got a bit of a framework there for embedding risk management in the organisation, let's start the risk management process. So we'll be looking at this in more detail on the next lecture, the next few steps, but the first step in our risk management process is to identify all of the risks that could affect the organisation. So we're going to look at them, we're going to categorize them, and we're going to think about what their impact could be. So the different types of risk that you can have within an organization, well, you could split them up between, first of all, strategic risks. So these would be risks that affect the mission of the organization and the strategic position. So these could maybe mean that your strategy doesn't work out, that perhaps competitors come up with a better product, maybe competitors come up with a better process. Something happens to mean that the competitive advantage that you thought you would gain, you simply don't gain. So that would be a strategic risk, the risk that your strategy doesn't work effectively. Or you could have an operational risk. Now this could be down to business operations. So maybe you have business operations that don't work in the way that you expected them to. Maybe you have control failures that mean that the business operations are ineffective. That's a different type of risk from strategic risk. So when we're categorizing the different types of risk that the organization faces, we can split them up between these two broad headings. We can then categorize all of the risks facing the business. So we're going to categorize them and we're going to think here about a few of the different categories that we could use. There are any number of categories that you could use, but these are a few that the syllabus specifically mentions and a few that you need to be aware of. So first of all, you have market risk. Market risk relates to the sector that the organisation operates in. So market risk is the risk that perhaps some competitors come into that sector with a better product or a different product, and that simply that affects the organisation. So market risk relates to whatever sector, or indeed it could be that that particular sector doesn't work anymore, isn't as profitable as it used to be. So that would be market risks. We could also have product risk. And that's simply the risk that the product fails. For example, Nokia, the mobile phone handset manufacturer, used to have the dominant position in the mobile phone market. But simply better products have come out, products that they produced that they thought would change the market and would be good in the market, simply didn't. Their product failed to do what they thought it would do, and that has affected the organisation to a great extent. So they're in serious trouble now. So that's a product risk, the risk that you have a product, you think it's going to do a certain amount for you, and it simply doesn't do that. We also have credit risk. So credit risk would relate to funding. Simply, maybe we can't get funded. This happened a lot with organisations who in 2007 took out 5-year debt. So they issued 5-year bonds. 5 years later, in 2012, they need to refinance those bonds, and the credit simply isn't available. The bond market isn't what it was in 2007. So those businesses are stuck. They have a financing deficit and they're not able to get the funding. That is credit risk. Liquidity risk relates to cash, so we're thinking here perhaps about your working capital. Your working capital, remember, being made up of your inventory, receivables, payables. So maybe you've got inefficient processes in place to manage those areas. The more working capital we require, the more cash the business requires. If you run out of cash, well, if you can't get funded by the bank, well, then you're going to be in trouble. So liquidity risk relates to cash and running out of cash. We could also have health and safety risks. So maybe failures in health and safety mean that someone injures themselves on your premises and you're sued on behalf of that. So that would be failures in health and safety, or indeed, maybe you don't keep up to date with health and safety regulations and you're fined because of that. Technology risk would relate to the technology that your business is using, and perhaps you fail to keep up with current technology. Or in fact, maybe your business is built on a technology that's rapidly changing. For example, businesses in the UK that sell DVDs and CDs, well, that market is rapidly diminishing as downloads take over. So that's technology risk. Those businesses are having problems. Even businesses that sell traditional books are having problems because of books being downloaded onto Kindles and onto computers. So that's technology risk. Technology changes, you fail to keep up, and that can detrimentally affect the business. Derivative risk, well, that simply relates to the use of derivatives such as futures, options, those sorts of things. If you use those derivatives, there's always going to be a risk. There's a lot of downside risk. They can move very rapidly and cause high losses because of the leverage nature of them. Reputation risk relates to the image of the business, and that can mean almost anything. It could be that maybe the product risk that we were talking about, the product fails because it was defective, and that has an impact on your reputation. So that would not only be a product risk, it would also be a reputation risk because people now don't trust your products. Lastly, we have legal risk. And that's simply the risk of legislation. For example, tobacco manufacturers. So they manufacture cigarettes. There are various pieces of legislation that come in that will affect those manufacturers. For example, not allowing them to advertise or not allowing cigarettes to be displayed on certain counters. So that's a legal risk. Legislation comes in and it affects your business in a detrimental way. So be able to look through a scenario and identify these risks, be able to give a brief definition of what those various risks are. As an organisation then, once we've categorised those risks and we understand what they are, we'll identify where they are in our current environment. So we'll use those categories and look for those risks that may affect us. So there may be generic risks, i.e. risks that affect all businesses. So for example, credit risk during the financial crisis, well, that didn't just affect one or two businesses, it affected all businesses. Or it could be specific risks, and that's risks that affect that particular business. For example, product risk, the risk that your product doesn't work out. Well, that's not going to affect other businesses, it's going to affect your business. And you need to understand the relationships between those different types of risk. And we're going to look in more detail in the next lecture at how risks can be correlated, how one risk can affect another risk. We'll then consider the impact of those risks. Again, we'll be looking at this in detail in the next lecture to see how we deal with the impact of the risks. But at this point, we're just thinking, what could the impact be of these risks? Firstly, on the stakeholders. So there are various stakeholders within the organisation. How are these risks going to impact on them? For example, the shareholders. Well, the shareholders could have a loss of value because, let's say again, taking the product risk where your product fails, well, maybe then people don't want to invest in the business and the share price goes down. Or maybe the business doesn't make the profit that it expected and again the share price goes down and the dividends expected aren't able to be paid. So loss of value for shareholders is the main impact that's possible from a lot of these different types of risk. When it comes to the board, well, their reputation or indeed their income could be affected. Remember, they're stakeholders too. So their reputation could be affected if the business doesn't work in the way that they expected, if it isn't as successful as they would have liked, well, then they're unlikely to get as good a job afterwards. Indeed, they may lose their current job and that would affect their income. For managers and employees, well, they're more concerned about job security. If the business was to fail because of one of these risks, well, then they might be out of a job. So that's the thing that they will be most concerned with. When it comes to customers, again, they'll be concerned with the loss of service, particularly if they've bought a product from the business and they expect an after-sales service. Well, if the business failed, that service wouldn't be available to them. When it comes to banks, well, if the risks are important enough and if the risks affect the business enough, it may lead them to default on a loan. So the business might default on a loan. That, of course, will affect the bank because they won't get the money back that they have lent to the business. So that's some of the impacts on stakeholders that we'll see from these various risks. So let's look at an illustration on this, just thinking about one of these particular categories of risk and how we might go about defining it and relating it to a specific business. In illustration 2, our requirement is to define liquidity risk and explain why it might be a significant risk to UU Limited. So we've already talked about the difficulties of getting liquidity risk embedded in the organisation, but what exactly is it? Well, liquidity risk, remember, refers to the difficulties that can rise with an inability of the company to meet its short-term financing needs, i.e. it's running out of cash. So it's ratio of short-term assets to short-term liabilities. So that means it's inventory and receivables less its payables. They have to fund that difference. The essential elements of managing liquidity risk are therefore the controls over receivables, payables, cash and inventories. So you need to try and collect your receivables as quickly as possible. You need to put pressure on your payables to take advantage of it as much as possible. And you need to turn over your inventory as quickly as possible. And that will be good working capital management. That will reduce the cash requirement of the business and reduce liquidity risk. So manufacturing has historically had a greater challenge with the management of liquidity risk compared to other sectors, especially low inventory businesses such as those in service industries. Now we see that Bob Ndumo is actually the non-executive director for some industries like that, and that's not comparable to the manufacturing industry. In the case of UU, there's 3 main reasons for the liquidity risk. Firstly, manufacturing usually requires higher working capital because it buys and sells physical inventory, and it does both of those on credit. That means that both payables and receivables are relatively high. So it also requires inventory in various forms, and therefore the management of inventory turnover is important. So we need to try to turn over our inventory as quickly as possible to get the cash back out of the inventory rather than tying it up. Secondly, manufacturing has complex management systems resulting from a more complex business model. So that means there's going to be complicated work in progress, and the management of the process can all put pressure on cash flows. So it's more complicated to actually get the cash out of a manufacturing management system. Thirdly, UU has a number of weaknesses that amplify its liquidity position as a manufacturer. We talked about those in the last illustration. Its ineffective credit control department and its voluntary 20-day supplier payment policy all increase the short-term cash pressure and thereby increase liquidity risk. So that's the liquidity risk that's faced by UU. That then was our lecture on risk management, the first lecture on risk management. We're now going to go on in the next lecture on risk management to look in more detail at a risk assessment and what that actually is and how it's going to be done before looking at how those risks are then dealt with.